Look, it's going to be counterintuitive, but my word of the day is blinders, right? In racehorses, you put blinders on so they stay focused on the race. There's going to be so much noise coming up in front of the election. Need to put your blinders on, focus that this is a bull market. Don't get distracted by the fact there's going to be a bunch coming at you over the next 40, 30, 45 days. Focus on earnings, focus on economic data, but put your blinders on, tune out the noise, because I think that's just volume's going to keep ratcheting up, unfortunately.
You know, Vicky, that may be easier said than done. We have quite the spectacle and some noise today, the East and Gulf Coast port strike. How do you see that impacting the markets?
So it depends on the longevity, right? If this is a week-long strike, it's estimated that would take about a month and a half to undo the backlog, about five days to undo every day of the strike. They're a little bit close, right? 77% raise versus 50% raise. They're hope they'll do this quickly, but a lot of retailers pulled forward imports. So if it's a week or less, I'm not too concerned. Retailers seem pretty confident from Costco to Walmart that, hey, we're good on inventory, we're good on holiday season, but we could see the cost of goods spike. And if the supply chain is disrupted for a longer period of time, obviously the second order effects of this strike have a huge magnitude. JP Morgan estimates about $4 billion of economic loss every day of this strike. So the question is longevity. If we keep it under a week, I feel pretty confident it's going to have a minimal effect. As it drags on longer, then it becomes a risk. This is a supply chain second order effect where all of a sudden it's going to be hard to find the goods you want, or the price spike inflation.
All right. So again, it's only day one. The White House has not intervened, forcing the two sides to a deal, but certainly getting involved in trying to help the two sides facilitate some type of deal and new contract. I do want to talk to you about if it lasts longer than a week, because right now it's very contentious. We played some sound from the ILA president earlier. We were looking at the Q4 EPS estimates for the S&P, materials and industrials. For the S&P is 13%, for materials is 14%, industrials 2%. As an investor, do you start to look at those estimates and think, well, they may be a bit too high if the supply chain disruption lasts a while?
It might be, but on the other side of that, one of the huge catalysts is the Chinese stimulus, and that could be huge for manufacturing, industrials, and the material sector. We've seen that spike last week. Things like FCX or Caterpillar, all of those reacting very positively to the aggressive stimulus on China. So right now, I think it's a little bit neutralized. On one hand, you have very bullish stimulus in China that see those sectors running. You have rate cuts that are also bullish for those sectors. But on the other, obviously, if we have things coming in, manufacturing equipment is one of those that could slow down. You've got no exports going out. So yeah, that's a risk to them, but I think they would possibly strike that, hey, this strike is a more tentative and lower, a shorter term event than this Chinese stimulus, which is a longer term bull effect that could boost earnings next year.
All right. I know you have your blinders on, but I want to play some sound for you. So you have your blinders on, but I know your ears are open. This is Jay Powell yesterday. I want to get your take on what he had to say.
This is not a committee that feels like it's in a hurry to cut rates quickly. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
All right, so Jay Powell saying if the economy performs as expected, 50 basis points of cuts for the rest of the year. I don't know if he's factoring in this strike. I don't know what else he's factoring in. But what do you make of those comments and the fact that we saw the Dow go from negative to just very fractionally positive following those comments?
You're right. It was a little bit hawkish. I think the market's pricing in about 70 basis points cuts as of this morning. But Powell's going to be data dependent. He's leaving all options on the table. He wants to warn investors that 50 basis points may not happen again. So they're not anticipating 50 basis points. Right now, it's about 34 basis points priced in November. So yeah, I think Powell's being cautious. He always wants to leave options on the table. He doesn't want to back himself into a corner. Goolsbee did address the strike a little bit in his comments. I'm sure all the Fed speak today, we're going to get more that, yeah, the supply chain could cause issues in inflation. And if we see inflation spike, that could continue to slow any Fed rate cuts coming. But I think overall, Powell's pretty bullish. You know, he referenced that the GDP is strong, that labor is slowing, but it's not necessarily declining. We're expecting 150,000 jobs on Friday, 4.2% unemployment. So that's why the markets ended up rallying out yesterday. I think they took that with stride and said, okay, Powell's a firm hand on the tiller, and he's keeping options open, but probably 25.
All right, let's get some of your stock picks for us today. One of them is Netflix. In fact, KeyBank actually given an upgrade to the stock today, raising its price target from $735 to $760, saying they believe that the content lineup should drive better viewership. Why do you think this is a good stock to buy right now?
Netflix Netflix is winning the streaming wars hands down, and they continue to expand their business. I don't understand why it's not the Magnificent Eight. I really argue that they should be part of the Mag 7, the fifth Beatle or something out there. But they're a fantastic company. Their content is great. Nielsen had them with 6 of the top 10 ranked shows last week. They continue to also monitor their content costs, and they're pushing into live sports, and they're getting into the ad-based tiers and how they're pricing their plans. They're moving people off and reducing plans, so they're pushing them towards the basic with ads. And so suddenly ad growth is there. Their subscriber growth has been strong, and I see that path forward for them. And so you can't, they're winning the streaming wars. How can you not like this stock? I know it's a little bit expensive, but the revenue continues to expand. They talk about a $500 million or 500 million user addressable market that they aren't into yet. They can get more into Asia. Fantastic stock.
All right, very quickly, the other pick for us is Costco. Any concerns about the strike impacting Costco's margins? Obviously shipping costs as well.
I mean, it's there, but margins have been growing. So I think they've got a little wiggle room. They're very well prepared for it. They actually addressed that a little bit. This has been something they've had on their radar. So I think Costco is ready to handle it. And I think they provide so much value to their members. They had their recent price hike. Their membership renewals still at 92.9%. Love the stock.